I'm Richard Kalordi, the Marketing Manager for HLB Mann, Judd in Perth, and today's financial reporting update will cover how COVID-19 has impacted financial reporting and the challenges associated with your next year end. It's my pleasure to welcome our three speakers today. Michelle Warren, HLB Mann Judd's Director of Financial Reporting Australasia, Carmen Ridley, Australian Accounting and Standards Board member, Marcus Ohm, Corporate and Audit Services Partner, HLB Mann Judd Perth. For our attendees, if you have any questions at all, please enter them through the Q&A box at the bottom of your screen and we will get to the questions at the end of the session. Now to kick off, let's go straight to our first speaker, Michelle Warren.
Thanks, Richard, and good morning to everyone that has tuned in. With everything that's happened over the course of the last few months and just the sheer speed at which developments have been unfolding, it is not easy to be on top of all the relief measures that are currently in place and know who they apply to. So I thought it would be worthwhile to just spend a few minutes providing an overview of the key relief measures that have been offered by regulators to assist entities in meeting their financial reporting obligations in the current environment. So starting next. So starting with for-profit entities and the relief around annual general meetings. So this would be relevant for listed and public unlisted entities. ASIC will not take any action if public companies with year ends from 31 December 2019 to 7 July 2020 do not hold their AGMs within the usual 5 months after year end, as long as the AGMs are held within 7 months after year end. So in effect, it's a 2-month extension, if you will. So for example, if you have a 30 June 2020 balance date, usually you would have to hold your AGM by 30 November 2020, but under the relief, you will be able to hold your AGM anytime up to the 31st of January 2021. So this is the case even if it means you do not hold at least one annual general meeting in the 2020 calendar year, which is normally required by the Corps Act. In response to restrictions on large gatherings, the Treasurer has temporarily amended the Corporations Act to facilitate the use of virtual AGMs by allowing company boards to provide notice of AGMs to the shareholders via email, achieve a quorum by reference to the shareholders attending online, and hold AGMs online. The important thing to remember is that these virtual meetings must continue to provide shareholders with a reasonable opportunity to participate. So for example, shareholders must still be able to put their questions to the board online and they must still be able to vote online. You'll notice there's some references on each slide. I'm speaking at quite a high level today, but these, if you want more detail on what I'm speaking about, please feel free to follow the links to the references. Next slide. So still with for-profits, the next measure I'd like to talk about relates to extended lodgement periods for financial reports. Now, keep in mind that ASIC has issued 2 lots of relief. The first announcement, which was made early April, only included unlisted entities with balance dates from 31 December 2019 to 31 March 2020, while the second announcement made just 2 weeks ago was aimed at both listed and unlisted entities and essentially extended the lodgement relief to include 30 June 2020 balance dates. So what I've put on this slide and the next 2 slides is a summary of the overall position, taking into account both ASIC announcements. So what is the relief? Well, ASIC has granted listed and unlisted entities an additional 1 month to lodge their financial reports. So to be eligible, your company must lodge financial reports under either Chapter 2M or Chapter 7 of the Corps Act, and you must have a balance date that falls somewhere between 31 December 2019 up to and including 7 July 2020. if your statutory deadline had already passed by the time that either instrument was officially registered, you cannot apply the relief. So let's quickly work through this for a 31 December 2019 balance date. Listed entities with a 31 December 2019 balance date, this relief cannot apply to you because ASIC's initial lodgement relief did not include listed entities. And under the later relief, your full year or half year statutory reporting deadline had already come and gone. However, for unlisted private companies with 31 December 2019 balance dates, the 1 month extension will apply to you under the initial or April relief. So your new reporting deadline is now 31 May and not 30 April 2020. With respect to grandfathered large proprietary companies, these companies are not required to lodge financial statements with ASIC, but they have to have their accounts audited within 4 months after reporting date. ASIC has confirmed that these companies will have an additional 1 month to complete their audits, as long as disclosure is made in the director's report that the ASIC relief has been applied. Moving on, on the next slide, I've summarized the extended lodgement periods per type of entity. Probably the most relevant one is the proprietary company extension from 4 months to 5 months, and also the listed company extension, the listed entity extension from 3 months to 4 months. But take note, that's really for our 31 March and 30 June reporters. Next. On this slide, if you are an AFS licensee, this just would be relevant for you, summarizing the extended lodgement periods. Next. All right, the third and final measure I'd like to talk about for for-profit entities relates to temporary flexibility under the Corporations Act. On the 23rd of March this year, the Australian government enacted the Coronavirus Economic Response Package Omnibus Act 2020. It's quite a mouthful. So this new legislation is designed to lessen the economic impact of COVID-19 and ultimately avoid unnecessary insolvencies. So the response package included quite a number of responses to the crisis, but the one I want to specifically mention today is the relaxation of the insolvent trading provisions under the Corporations Act, which effectively provides for a 6-month moratorium on directors having personal liability for trading whilst insolvent. So the way that it works is that a breach of duty to prevent insolvent trading does not occur if the debt is incurred, number one, in the ordinary course of business, number two, during the prescribed 6-month period being 25th of March to 25th of September this year, and number three, before the appointment of any administrator or liquidator. I'd like to just take the opportunity to make the point that this temporary safe harbor measure is by no means a get out of jail free card for directors. The purpose of this temporary economic measure is to facilitate the continuation of businesses during the 6-month period and hopefully allow them to return to viability once the crisis has passed. Directors that wish to rely on this provision may have to make sure that they have evidence that supports that the debt was in fact incurred in the ordinary course of business during the prescribed 6-month period and before the appointment of an administrator or liquidator. It's probably also a good time to remind directors that the obligation to prevent insolvent trading operates alongside the general duties of directors arising under the Corps Act. So these general duties are not trumped by this temporary safe harbor measure that I've just spoken about. Probably also good to highlight that this temporary safe harbour measure does not at all impact or change the financial reporting requirements relating to solvency declarations and going concern. The directors are still required to make and sign a solvency declaration and make an assessment of the company's ability to continue as a going concern. All right, next slide. Moving on to not-for-profit entities. We'll start with lodgement relief. For those not-for-profits that are registered with the ACNC, normally you have 6 months from year-end to lodge your annual information statement. The ACNC has granted a blanket extension that applies to all annual information statements that are due between the 12th of March and the 30th of August 2020, with the new due dates for submission being the 31st of August 2020. For charities with 31 March or 30 June 2020 balance dates, there is currently no deadline deferral available to you, but the ACNC has said that it will continue to monitor the COVID-19 situation and announce further extensions if warranted. Also, just note that if you were a charity that was affected by the bushfires and you were granted an extension to May 2020 to submit your annual information statement, this blanket extension that I've just spoken about will apply to you too. All right, next slide. For those, still with lodgement relief, for those not-for-profits that are not registered with the ACNC but report under the Corps Act, so companies limited by guarantee, ASIC's 1 month extension that I spoke about a few slides back will apply to you. So that would mean that your lodgement period has been extended from 4 months to 5 months, where your year end falls between 31 December 2019 and 7 July 2020. All right, moving on. Next slide. Moving on to AGMs and other meetings of not-for-profits. I'm sure many of you already may have experienced, but physical distancing restrictions and delays in having financial statements audited or reviewed, it's making it very difficult for not-for-profits to hold their meetings, including their annual general meetings. So ASIC and state and territory regulators have taken steps to assist not-for-profits in this regard. For those not-for-profits that operate as companies limited by guarantee, I've already discussed ASIC's no action position on AGMs and the use of virtual meetings, so that would apply to you. For not-for-profits that are incorporated associations, the relief surrounding AGMs will differ depending on which state or territory you're in. If you have not already done so, I would strongly encourage you to visit the ACNC's website. It has a dedicated COVID-19 webpage, and on there are links to the various regulators' web pages that set out their specific AGM relief, as well as any actions entities might have to take to be eligible for that relief. So, for example, some regulators are offering more blanket type relief, whereas others are offering relief more on an application by application basis. So I do strongly encourage you to visit the ACNC's website should you need further information specific to your entity. Probably worth mentioning that where not-for-profits do decide to push ahead and hold their AGMs virtually, I would suggest that you just check that your governing document as well as state and territory regulation allows for this. If they don't, you may just have to explore the process involved for changing those rules, which may require seeking some professional advice. In any event where you are making decisions that are different to how you would normally be running your AGM, for example, it's a good idea that you document these decisions, you make sure that the responsible people are aware of them, and you communicate them with your members. And this probably holds true for any decisions or unusual decisions that you are making in the current environment. Next. And the last measure I'd like to discuss relating to not-for-profits is with respect to compliance with certain governance standards and external conduct standards. So charities are facing unique challenges as a result of COVID-19, and it's making it difficult for them to comply with certain obligations arising under the ACNC Act and other legislation. So in acknowledgement of this, the ACNC has taken the position that it will not investigate certain breaches of governance standards and external conduct standards that happened between the 25th of March and the 25th of September this year. So currently there are 3 circumstances where this no action position applies. Firstly, where a charity operates outside of its charitable position. Secondly, where a charity incurs debts such that it becomes insolvent while operating. And thirdly, where a charity is unable to get financial reporting from its overseas partners or operations. Now, again, the ACNC's short-term no action position is very much conditional. For example, if we just focus for a minute on the second circumstance, operating whilst insolvent, the way that this measure works is very similar to the way that the Corps Act relief measure works under the economic response package. Charities wishing to rely on this temporary safe harbor measure will have to be able to prove that the requirements have been met. That is, that the debt was incurred in the ordinary course of operations within the prescribed 6-month period and before any administrator or liquidator was appointed. Also, charities would be required to ensure that the responsible people are aware of what's going on and that they have an achievable plan to operate through the crisis. Just a reminder that despite this 6-month period of relief, charities still have a duty to inform their members and the ACNC if they are operating whilst insolvent. So bottom line, if any of these circumstances do apply to you, it's worthwhile visiting the ACNC's website to understand the conditions on which no action will be taken and make sure you meet these or you take the necessary steps to meet these. That's it from me. I'll now hand over to Carmen, who will highlight some financial statement areas that could possibly be impacted by COVID-19.
Fantastic, and thanks, Michelle. So we're going to talk through some financial reporting areas. Just a normal disclaimer, obviously this is training purposes. I'm not giving anybody specific advice on their financials because I'm not looking at your financial statements. So if we move on, next slide please. And if we look at some of the impacts, it's actually really hard to talk about the financial statement impacts of COVID-19 because the answer to so many things in financial reporting is it depends. We have got some organisations that this is the best thing that has ever happened to them. We've got most other organisations where that's not necessarily the case. So the first quote that I've got in that sentence at the top of the slide, I initially stole from an IASB member, and it was a few years ago. It was nothing to do with COVID-19. And he made a comment and he said, other than cash, everything in the balance sheet has got some estimates, judgments and assumptions. And when we're looking at the impact of COVID-19, that's a really great place to start because every estimate, judgment and assumption that we've made over the past however long has been thrown up in the air, shaken around and dropped on the floor. We cannot use any of those same assumptions and we have to actually think very carefully about what assumptions we're going to use today. Now that's not easy because we don't know. We don't know how long this current scenario is going to last. It depends on your locations. Most of you guys are located in Western Australia. Michelle and I are located in Victoria. We're in a very different situation from what you are over there. So if you've got operations in different states, you may find that some of them have got back to normal much quicker than others. So I can't give you a list of every single area that's going to be impacted. What I have done is try to highlight some key points that you may or may not have thought about, that I can just give you some awareness of the issues. The first one is in regard to provisions. And I'm looking at the provisions that are in the scope of AASB 137. We don't generally see onerous contract provisions. It just hasn't really been a thing over the last however many financial reporting periods. We may well see them at the current reporting period. And this is because we've had facilities that have had to close. We've had maybe reopenings, yet obviously the turnover is not where it was, but we are still locked in to certain supply contracts, to certain sales contracts. And therefore it's actually costing us more to have this particular contract, but we can't get out of it. It would be more expensive for us to get out of it, so may result in an onerous contract provision. Unfortunately, we have seen entities that have had to do some restructuring. We have seen situations where entities have closed down loss-making businesses that they thought they could carry on supporting. They just can't in the current environment. Redundancies, etc. We are expecting to see more restructuring provisions at 30 June. Remember, there are criteria within AASB 137 to recognise those, including having communicated to the relevant people. In regard to make good provisions, you would have all been looking at your leases for adopting AASB 16. And as part of that, you would have been looking at your make good provisions. You expected that you were going to renew that lease, and therefore you expected that your make good provision would be paid out in, let's say, 5 years' time. We now don't think that's going to happen. People may have been working beautifully from home, and why are we paying for 5 floors of a building, whereas we can possibly just rent 1 floor of the building and we rotate who works from home. So you might have to bring forward when that make good will have to be incurred, potential different different expenses in relation to that. We'll talk a bit more about leases on the next slide as well, but just from the provisions aspect, that make good's really important to think about. Foreign exchange balances, those of you who have any transactions overseas, there's no change about translating any balances at the year end. It's exactly the same as what it always has been. We translate at the closing rate. The area where we might see a change is for the transaction or translation of our transactions. So the P&L impact, because the standard tells us that we translate at the rate at the date of transaction. Generally, what we see is people use an average. It may not be possible to do that anymore, because if the average has been this long, yet exchange rates have gone like this during the period, we have to shorten that. So when we're looking at that average rate, it may be that we're using a weekly average rate rather than a 6-monthly average rate. And it therefore might be easier to just do the rate at the date of transaction. So again, don't assume we can use average rates for translation of the income statement. Economic stimulus packages, there has been a fair number, both from the federal government and the state government. And how do we go about accounting for those? Michelle and I sit in a number of technical discussion groups, and there are differing views in how to account for some of these among those technical accountants. The AASB staff are working on more frequently asked questions, and the one that they're focusing on at the moment is around accounting for the economic stimulus packages, because they are very Australian specific. Nobody else has the JobKeeper the way we do, for example. So there will be some guidance coming out on that. It will not be authoritative because it will be issued by the AASB staff, not the AASB board. However, it will be some good guidance. The general view is that potentially we have different treatment for a not-for-profit compared to a for-profit. For for-profits, this is likely to be in the scope of AASB 120, and you are likely to have a choice between recognising it gross as income and your employee expenses, or netting it against employee expenses. Not-for-profits likely to be within the scope of AASB 1058, and there is no option to offset. You would be recognising it as income. That seems to be the general consensus, but watch this space for that staff FAQ that's coming out. Most of the other stimulus packages seem to be a similar type of approach, but obviously I'm aware that some of you may be operating in certain industries that you've got very specific packages, so it's worth making sure you think about them where they are material to you. Anyone who has recognised a deferred tax asset because you were turning around your loss, you're going to do really, really well, and now possibly you're not, needs to make sure that you have looked at those deferred tax assets. Just because you thought it was probable you were going to realise them last year doesn't mean it's probable this year. So we may actually have to see reversals of deferred tax assets. It's not necessarily an impairment, it's a reversal because we no longer believe we meet that probable criteria. When we think about the most obvious impact of COVID-19, impairment is the one that comes to mind. I'm not going to talk in huge detail about impairment. What I do want to say, however, is think about the asset that you have, because the asset that you are assessing for impairment will depend on the model that you have to use to make that assessment. So for example, if we've got tangible assets, intangible assets, or right of use assets, you will be in AASB 136, the impairment of asset standard. That requires you to look and assess whether there's been an impairment indicator. One of the impairment indicators is that we are suffering a decline in economic conditions. Pretty much every single entity, I would say, is going to have that impairment indicator. You would really struggle to convince me that you aren't seeing that indicator happening. So therefore, you then have to go through and do that assessment of recoverable amount. Higher of fair value less cost to sell and value in use. Value in use is a discounted cash flow calculation. So both of those elements, one is fair value, one is a discounted cash flow, both of which require estimations. And therefore, what process are you going through? What assumptions are you using? Because it will not be the same as the ones you used in previous periods. In regard to receivables, remember last year we got AASB 9, and AASB 9 introduced our expected credit loss model, which means that we actually really have to think, today, the day we issue that instrument, what do we think the expected loss is going to be? Not let's wait until the debt becomes old and then let's put a provision through. What do we think the loss is going to be on day one? What we are seeing is that entities developed a model last year, and the model is putting out this result. Yet they're saying that's not right in the current environment. So we're seeing what they're calling a COVID overlay that sits on top of that. They're not necessarily changing this model, they're actually adding an extra bit to it. If you want to have a look at what that looks like, the big four banks released their half-year results as at 31st of March. Every one of them has got a COVID-19 overlay for their expected credit losses. Probably not suspecting that your figures will be anywhere near the same as their figures, but it's useful to have a look at some of their disclosures and their methodology. In respect to inventories, inventories aren't actually in the impairment standard, but they've got their own little impairment test within their own standard. So we recognise inventories at the lower of cost and net realisable value. We have seen people who are spending their money on essentials rather than luxury items. So if you are in the business of selling something that could be deemed as a luxury item and you're finding you're having to heavily discount to be able to sell, potentially we've got an NRV provision within that. So certainly, whilst it's not in the impairment standard, it's not exempt from impairment. In relation to valuations, two types of assets I want to talk about for valuations. The first one is investments. Now, if we have a holding in a listed entity, we know probably the value of that has dropped. But it's also very easy to get the figure because we can log on to the relevant stock exchange, look up the share price, and we know the answer. Much harder for an unlisted investment. Remember, AASB 9 no longer lets you hold any equity investment at cost. You have to hold it at fair value. It has been challenging enough to try and get valuations or fair values of unlisted entities in the situation last year. In this economic condition, to try and get those valuations of unlisted entities is going to be incredibly challenging, particularly where they are located overseas. So just start thinking about that. How are we going to obtain that fair value? If you choose to hold your infrastructure, property, plant and equipment at fair value, we have to assess whether the current carrying amount is materially different from fair value. To do that, we have to have some inkling of what the current fair value is going to be. And many of you may engage a valuer to assist with that. We are seeing some significant disclaimers being put into valuation reports at the moment. We are seeing valuers who only want to give a range of value. It'll fit somewhere between here and here. Well, that's no good for financial reporting purposes. We can't have a balance sheet that is a range. So therefore, we need to make sure when we are providing instructions to valuers, it is very clear that we need a number. Even if they want to come up with a range, they have to use professional judgment to actually give us a number to use. Think about using the valuers and whether it's better off just using some of the indices that are out there. If your valuer is not going to give you a real number that you can use, think about whether there are alternative approaches that you can take for obtaining that fair value. Employee benefit provisions. This is another one of it depends. I've had some organisations have told me that their employee benefit provisions plummet because they are asking, in inverted commas, employees to take leave. Annual leave, long service leave, and therefore the value has dropped dramatically. I've had other entities who've said to me, well, nobody's taking their leave because the employees keep telling us we've got nowhere to go. So therefore, our employee benefit provisions are actually increasing quite significantly. What we do know is the behaviour of those employee benefit provisions will not be the same as what it's been in previous years. So what systems have we got in place to be tracking that? We can't do a sense check compared to prior year because it won't be the same. So when everyone's working remotely, how are we tracking these leave provisions? From a revenue perspective, we obviously have a new revenue standard for the for-profits who are listening, kicked in for you last year. For the not-for-profits listening, you are probably slap bang in the middle of trying to work out the impact of these revenue standards. If we think about AASB 15, there's a 5-step process, and the first step involves identifying the contract. Now, we know the contract can be written, verbal, or implied. What we know is it has to be enforceable. If your contracts contain the force majeure clause, your contract may no longer be enforceable in the current climate. If your contract is not enforceable, you are not within the scope of AASB 15. So all of your revenue recognition methodology has just gone out of the window. So that's the first thing that we have to do. Are we still dealing with an enforceable contract? And if not, how are we now going to account for it? There are some rules around how we do that. In the not-for-profit space, you are probably kicked back into 1050A. If we think about where we are giving refunds, we can't provide a service, or we kind of can, but no one can travel to get to us. We're probably giving much more refunds. Our customary business practice has changed. So that will affect our variable consideration. Remember, we can only recognise the revenue we expect to receive. If you expect to give a refund, your expected consideration is nil. We also might have situations where there are bonuses. We got a bonus if we finished something early, and we thought we were going to finish it early because we always do, except we're now in the middle of a pandemic. So therefore, potentially that revenue that we've been recognising that included a bonus has to now be reversed. So again, don't assume that the estimates, judgments that you used in previous periods are right. We may see some reversals of that. If we move to share-based payments, generally we would recognise the share-based payments based on the probability of instruments we believe are going to vest. If the share price has plummeted, your probability may have also plummeted, because why would I exercise this option? I might as well just buy it from the market because it is cheaper. So therefore we may see some significant changes in share-based payment expense. And I know in certain entities in WA, share-based payment instruments are used significantly. So just be aware of that. You may actually end up with a negative expense if you've completely reversed those, depending on the vesting conditions. In respect of contingent consideration, we bought a business 3 years ago and we paid $3 million for it. And we told the previous owner that if EBIT, revenue, whatever figure you want to choose, had increased by a certain percentage, we would pay them an additional $500,000. Things were going great guns. We absolutely believed we were going to have to pay that $500,000, and we recognised it in our accounts. Then we were hit with the pandemic. We're not looking great now, and therefore potentially a provision that we've got recorded may need to be released. So the key message is, don't assume what you had in a previous period is still valid for the current period. Obviously, overlying all of those is going concern. So when we think about going concern, it is going to be one of the biggest issues that we will be facing at the reporting period. And certainly when Marcus talks from an audit perspective, he'll be discussing going concern and some of those implications. So if we can move on to talk about leases and what has been happening in there. We have seen an amendment from the International Standards Board, and they proposed making a change to AASB 16. It was issued with a really short comment period, 14 days, which is unknown in standard setting world. And what it said was, we know that there are lots of modifications that are going on at the moment with leases, rent concessions, rent abatements, deferrals, etc. And they're happening because of COVID-19. The lease modification guidance in AASB 16, if any of you have looked at it, you will know how onerous it is. Huge amounts of work. So the International Board said, okay, where the change is due to COVID-19, and there are certain conditions that they proposed, we will allow as a practical expedient that lessees will not have to go through that modification guidance. They can treat the change as effectively a variable lease payment and put it through the P&L in the current year. The comment period ended on the 8th of May. The International Board met a week later, and it was agreed within that meeting that they would issue a standard based on the exposure draft. We are expecting the standard to be out by the end of May, which is not many days' time. Keep your eye out for that if you do have those lease modifications, because this will make your life easier. The International Board did not propose any changes for lessors. A lot of comment letters said, please put some changes in for lessors, and they decided not to at this point. I'm not sure how much pressure they're going to keep getting. We may see something coming. I'm not sure this is the end of this, but certainly the standard that is coming out at the end of May is only applicable for lessees. So just something to keep your eye on. So we're going to move now on to some of the things that ASIC have been putting out. Traditionally, we get the ASIC focus areas end of May, beginning of June. They have very recently released some frequently asked questions on COVID-19, which are very good. Would highly recommend having a look at. I've picked a couple of them to talk about. Hidden within those FAQs, they slip these focus areas, but give a very defined, these are the reporting years that they relate to. We have been told there are still focus areas coming. I suspect it will look very much like this ones here. Most of the things I've just talked about are on here. So for example, value of assets, liabilities, provisions, etc. Estimates, assumptions, judgments. They have talked particularly for listeds in the operating and financial review to make sure that we are giving much more information than we would previously. Talk about risks, talk about business strategies, talk about future prospects. And I'll talk about some disclosures on the next couple of slides. They've also talked about going concern. They've talked about subsequent events. Now, the interesting thing for year ends now is COVID-19 and the associated government interventions are in play. So it's not a non-adjusting subsequent event that we saw at December. So you have to make sure that your transactions at the year end reflect reflect the conditions that were in place at the year end, which is COVID-19 and the associated government interventions. So we might see some adjustments. They did also remind people that AASB 16 is still in play. We did discuss it at the board level and decided we were not deferring the effective date. So if any of you are hanging out thinking maybe we're going to change that, we're not at the board level. So if we move on to some of the comments that they've made around disclosures, and this shouldn't be a surprise to anybody. This is not particular to COVID-19, but I think it's really useful that ASIC have given a frequently asked question about what should the disclosures look like, because they're telling us essentially that disclosures should be specific to the entity. I've had lots of questions about, can I write a blanket disclosure for COVID-19? No, I can't, because I don't know what the impact on your entity is. It is very specific to you. So you have to think about what's been the impact, what assumptions and judgments have you used in coming up with forecasts and coming up with your impairment testing. The directors need to know about these assumptions and judgments. They need to discuss them at the meetings. The auditors will challenge those judgments. We traditionally see that people are quite cautious about disclosures and go, I can't give that, it'll give too much information about the entity. The disclosures for this year have to be the best disclosures we've ever given to tell me the story about how COVID-19 has impacted you. You don't need to tell me that COVID-19 exists. I know, I've been stuck at home for 3 months. So therefore, you don't need to tell me that. What I want to know is what's the impact on you. In the Fin review this morning, and I know your timing is a little bit different from us, so you may not have had a chance to read the Fin review. There is an article, and I will read the headline. It says, ASIC braces for misleading EBITDA-C disclosures. The C is obviously coronavirus. This article is talking about particularly a German entity who has tried to do pre-COVID disclosure and post-COVID disclosure. ASIC are not happy that this might be occurring. They've actually updated their frequently asked questions to say how problematic it is. You have no idea what would have happened if COVID-19 hadn't hit. You may have been budgeting a 30% increase in your revenue, but nobody knows what actually would have happened. So just be very, very careful, any of you who are listening, thinking, fantastic, let's try and do this different result. Let's try and split things differently. We really need to make sure we're still complying with the standard. So moving on to the next slide. The next comment that ASIC made in regard to the frequently asked questions, and I haven't gone through every frequently asked questions, as I say, strongly encourage you to look at them. I thought this one was interesting, which is why I put it in here. We all know that most people are suffering badly. There are some entities, however, who have had hugely increased revenue or have had decreased expenditure. And ASIC have just pointed out that that's fantastic. Just make sure that you are telling the story about how sustainable that is. So let's use the toilet roll example. We've had people who have panic bought toilet roll over the last however months. They have more toilet roll in their house than you can shake a stick at, and it's going to last them for probably the next 5 years. Therefore, the sales of toilet rolls, where they've been really high in the last few months, probably aren't going to be quite as high in the next however long. Toilet rolls don't go out of date. You can just keep them for however long. So ASIC have just reminded us that even if we've seen really high revenue or we've seen lower expenses, and the example I've used there for elective surgery, you know that somebody needs elective surgery. However, it has had to be postponed. You've still got a liability there because that surgery needs to happen. It looks like your expenses have dropped, but make sure that you are recording appropriate liabilities. So again, it's just part of that tell the story. Tell us what's actually happening. Tell us about the assumptions that you have used. Don't just talk about what a wonderful however many months you've had because revenue has increased or expenditure has decreased. So if we move on, and I am handing over to Marcus now. So Marcus is going to talk us through some audit considerations.
Thank you very much, Carmen. Good morning, everybody. So far today we've heard about the regulatory relief measures. We've talked about the financial reporting implications, of which the many, unfortunately. So really the only remaining thing is to just talk through what some of the audit implications are. So I just want to talk for about 10 minutes just in relation to this slide and just some considerations for all of us to think about. Now, the first one really to talk about there is just some of the practical issues. So not even the financial reporting at this stage, just the practical issues. And of course, the first one of those really is, can we conduct the audit on site as we have done in the past, really since the birth of auditing, or do we have to do that off site? If we need to do the audit on site, things like physical distancing come into play. I've been told we can't call it social distancing anymore, it's physical distancing. So for the safety of our staff and also your staff, is it possible to maintain that? If the audit's going to be off-site, again, one of the issues there is access to electronic records. Now, we've been doing quite a lot of audits remotely for a while now, so hopefully that's not so much of a problem. But if your records are primarily physical rather than actually scanned, we might need to think about how we're going to approach that. There are some real specific issues as well, such as inventory counts is the one that springs to mind. Inventory counts are going to become a bit of an issue for us in about 4 weeks' time. So now there could be physical restrictions there in terms of access to inventory. There could be geographic restrictions. I have a client in Geraldton, and up until last week, I was actually trying to work out how we're going to actually conduct the audit up there. Unfortunately, Mark McGowan has released some of the restrictions, so that is not as much of an issue as it was previously. Now, obviously, there's ways around inventory issues. The use of technology is one, which would have to obviously be directed by the audit team. You might be a mining client, so there's things to consider there as well. Some of the options there are rollback testing, things like looking at subsequent outturns. So I think with a lot of inventory issues, certainly the restrictions appear to be easing a little bit now. So hopefully this is not as much of an issue as we thought it was going to be. And obviously there's ways around a lot of it, hopefully, in terms of how we treat that. So I'll move on to the audit approach, significant risks and disclosures. So Carmen had a very good slide earlier on just in terms of some of the issues for us to think about. Perhaps if I can just sort of group the issues from an audit perspective into asset values and then also going concern. Now with asset values, again, we had a lot of detail earlier on. It could be property valuations, could be expected credit loss, unlisted investments. One of the areas where I think we will have a big audit impact is potentially in relation to things such as intangible assets. So that could be goodwill, it could be intellectual property. You know, if you're a mining client, it could be mine properties. So we're going to have some asset values that are based on things such as discounted cash flow calculations. So the likelihood is it's going to be very difficult to argue in many ways that there is actually no impairment indicators. So if you're under 136, the chances are we're going to be in a DCF or value in use sort of scenario. Obviously, the real issue is just the uncertainty of the cash flows. That's going to be the biggest challenge, I think, in all of this. So obviously, when you're preparing these cash flows, you would have had some assumptions in terms of how you put those cash flows together. From an audit perspective, we really just need as much evidence as it's possible to gather. So if you can just try and document as much as possible just to assist us through the audit process in terms of how you've arrived at those cash flows. Going concern is generally going to be a more prevalent issue, we would have thought, this time around. Now, for some of you, going concern actually isn't an issue. We know some of you have actually successfully raised capital so far, and you're probably quite well placed as possible as that is during these sort of uncertain times. But there's going to be other people that going concern is actually a significant issue, and it might be the first time it's been an issue for you. Now, one of the things we'll need is a cash flow forecast that goes out 12 months from the anticipated date of approval of the accounts. Now, that's not to say if you think you're going to run out of money in month 13 or month 14, that's okay. But certainly the 12-month is the initial period we'll be looking at. Now, with the cash flow forecast, I'd encourage you really just to try and put as much science into that as possible. It's not just an audit issue, it's a commercial issue about, you know, the survival and the ongoing viability of the business. So it's very important that there's a lot of rigor behind that. And from the audit point of view, really, we just need as much support as possible for the assumptions. If it's a capital raising, maybe you've already entered into discussions and you can provide us with some evidence around that. Now, the audit report is, again, this is really going to differ for a lot of people. Hopefully, we don't have big impacts in audit reports going forward. Now, an easy way to think about the audit report is the purpose of the audit really is to get sufficient appropriate audit evidence in relation to the financial statement assertions and the financial statements overall. So where we have managed to get enough evidence, you could be in a situation where you have an emphasis of matter. Now, perhaps if there's any junior explorers or other entities here, they may be familiar already with emphasis of matter's ongoing concern. So really an emphasis matter is saying, look, we've got enough evidence, but there's a matter that's of such significance for the user's understanding of the financial report as a whole that we feel the need to reference that in our audit report. So going concern is probably the most common area. Where you have uncertainties over cash flows and valuations, and there's a wide range of possible outcomes, which Carmen referred to earlier, there is theoretically a possibility that you could have emphasis matters in other areas as well. ASIC have actually come out and said, look, we don't believe emphasis matters should be overused. We believe it takes away from the usability of the financial report as a whole, and I think there's a lot of merit in that. Obviously, it's not really ASIC's decision at the end of the day, it's down to the engagement team, but hopefully we don't see more of those than we have in the past, but it's certainly a possibility. Now, just very quickly, the other audit reports that could happen is one of them is a disclaimer of opinion. These are scenarios where we haven't been able to get enough evidence, and the usual scenario there would be something like going concern. I think these will still be fairly rare, to be honest with you. We don't see a lot of these issues. It would really only be if the company was in pretty dire financial straits that we get something like that. It's more likely to be the EOM front. So just moving on quickly, just so we have enough time for the Q&A at the end. As if all this wasn't sort of bad enough, you've actually got some new accounting standards to think about as well. So Carmen mentioned earlier, we've got 15 and 1058 for NFPs. Now, for the leasing standard 16, if you're a listed company, you would have already gone through that in your half year, but for other companies, this will be the first time you've had to consider that. Interestingly, ASIC has communicated to us that coming out of their financial reporting surveillance program, what they've seen is most of their queries have been around revenue recognition. They've actually had very few queries in relation to leasing, which I found somewhat surprising. I'd like to take that as meaning that we've all done a fantastic job in relation to leasing, but somehow I don't think ASIC could be willing to put that on record. So lastly, just communication is vital. So we've got a whole lot of potential issues. You know, it may well be quite depressing in some ways to think about all the things we have to work through, but I think with everything, you know, sort of a positive constructive attitude is key. And with communication, we can work through all those sort of issues together quite successfully. So Richard, with that, I'll finish up and I'll pass it back to you.
Thank you, Marcus. And thank you to all of our speakers. I'm now going to just quickly go to the questions that have come through. The first question is around JobKeeper, and I'll ask it directly. Any guidance or thoughts around the accrual of JobKeeper or other stimulus packages at year end?
All right, so I'll take this one. In regard to JobKeeper, my understanding is that it is linked to the payroll, and therefore, if you are already in the JobKeeper system, you will just recognise that accrual based on the accrual that you would have, the accrual that you were waiting in relation to that payroll. Wouldn't imagine it would be hugely material for most entities, but certainly that's how it would work. The PAYG credit one is possibly one where there are differing views on it. So the way that I understand that works is if you've got the PAYG credit for effectively the March quarter and you're on quarterly, then you pretty much just seem to get the next one as long as you are still in business. So there has been discussions at some of the technical groups around should you be recognising that as an accrual at 30th June, even though you know you're not getting it till July. If the understanding is right that as long as you're in business you get it, then I would say there's a pretty good argument for recognising that accrual. Similar thing on a monthly basis, it's just the accrual is unlikely to be as big.
Okay. Thanks, Carmen. That's it for all of our questions, everybody. I'd like to thank this morning Marcus, Carmen, and Michelle for your time. Oh, hang on a sec. One more question. Sorry. Are you saying we should accrue JobKeeper through to 27th of September or just 30 June?
No, not all the way to September.
I couldn't find my unmute button. Yeah, so only up to, you're only entitled to it, from my understanding, the way JobKeeper works, as you are paying each employee. So it would only be up to 30 June. It's the PAYG credit that potentially is different.
Great. Okay. Thanks, Carmen. On that note, I think that we will end the webinar. Once again, thank you to our speakers and thank you to our audience for your time. And we'll see you at the next webinar. Thanks, everyone.
Thanks, Richard.
Thank
Bye,
you.
everyone.
Thanks. Bye.